Welcome, everyone, to another edition of the Tony Sirianni podcast. This is our market update section. This has been a lot of fun talking to both Paul and Art. So from B. Riley, and I just want to say thanks again for being on the show. Love having you guys here. And
thanks so much for having us.
You're welcome. You're welcome. And Art's in one of my favorite places, Nantucket, and Paul's in my other favorite place, Middleburg. So that you're both, I'm tuned into where you are. So just FYI. We have a lot to talk about. I mean, we've been going over sort of soft landing or a hard landing. What is it going to be? We seem to have more information now, so I kind of want to know, what you guys are thinking. Just briefly, are you still in your position? I'm Paul. You were for hard landing. Art, you were for soft. So, Paul, you go first.
No, one of the things that I think investors have to know is that you can have a relatively shallow recession and still have a big drop in the stock market. And I've always equated a soft landing with not really a recession. There's no question we're going into a recession. All the leading economic indicators and the yield curve, all of them seem to suggest now that we will be going into the recession formally in the second quarter of this year, sometime in April or May. But I actually think that because of the employment situation, that we're going to have a rather shallow recession, meaning that we may have GDP negative growth, 0.2 to 0.4%, which isn't bad. But if you look at previous recessions, 2001 and 2002, that recession was a very, very shallow recession, and yet the market went down 49%. The S&P went down 49%. In 73 and 75, which I think is the closest to what we're going through now because it had the global inflation as well as a lot of massive printing of money, the market, the GDP negative growth was very low, but the market went down 44%. So investors shouldn't think because we're going to have a shallow recession that we won't see a big drop in the stock market.
All right, Art.
Yeah, I would tell you, I agree with Paul in so much as he talks about the strength of the labor market. And I think that when we think about what could either, keep this recession or the soft landing short in duration, I think the strength of the labor market is one very important piece of it. But I think when you try to find that perfect analog to what's going on in 2023, I think it's virtually impossible to go back to, let's say 73 through 75, where we had inflation embedded in expectations and the Fed had to raise rates to 20%. I think we're at a different place in the here and now. And if you go back to 2021, 22, that's the end of a dot-com bubble. So obviously the after effects is from you fall a lot further when you've gone too far too fast. So I think we're at a different place now. We entered last year with a multiple on the S&P 500 about 22 times. We exited the year at 17.5 times. So we're actually at a much more rational place in valuations. Working our way through the earnings reporting season, we haven't breached 18 times on a forward basis. So I think that we're reasonably priced coming into what is likely going to be an economic slowdown. And I think that tamps down how much damage there is to markets.
So you both mentioned this sort of unique place that the employment market has, right? So there's a reading this morning, there's 10.5 million open jobs. But the other thing I read every day is layoffs, you know what I mean? And then there's jobs and there's jobs. There's, a lot of part-time workers that had part-time jobs and they can't get the hours. And so the paychecks are down. And I also want to relate this to some of the sort of new age thinking of quiet quitting and all that. I want to work from home. There were weird pressures on the job market that maybe, weren't there. So if you guys could talk a little bit about jobs and why we're seeing layoffs and hearing about layoffs and maybe slower, and at the same time hearing there's so many jobs available. What's the issue there?
I'll take the first swing at that.
Yeah.
I think that Primarily, technology companies have announced the largest bolus of the layoffs, and that number, if you go back to the middle of summer all the way through last week, is north of 100,000 jobs, which sounds an awful lot, except until you go back and say, well, how much did they hire between 20 and 22? Massive overhiring across the board. Whether you look at a company like Amazon that had 600,000 employees back in 2018, exited 21 with 1.6 million employees. So it's just massive overhiring at that point in time when they just didn't know how long this lockdown and pandemic was going to be. So what we're really seeing in technology companies is a right sizing of their employment base for what we expect the economic demands on their companies will be. I think that's important. I think that, but the point you brought up about JOLTS is also important. We need that to come down. And that's why we're not seeing all these layoffs that are being announced showing up in the weekly jobless claims, because there's still open jobs. You can imagine if you and I were running a small and medium business, and we've always wanted a great engineer, software, a coder, a software salesman, et cetera, but we couldn't compete with the likes of Google and Facebook and Apple and Amazon. And then these people become available. We're going to take them into our small and medium business. At the very same time, companies like Alphabet or Google are giving very, very generous severance packages. So you're getting fired, but then you get 6 to 8 weeks of severance. So you don't show up in the unemployment. I think that's going to start to show up. And I think that's important. That's one of the things that the Fed points to all the time. There's too many jobs available.
So Paul, there's also in the finance industry, people are starting to lay people off. I mean, I feel badly. Some of these poor CEOs are only making like 25 million this year. I mean, they're really taking on the chin for everybody.
Yeah, they're not getting any of their bonuses. Yeah, basically, you got to put this in perspective. You are seeing a lot of layoffs, but they are tiny compared to the 10.5 million jobs. I agree with Art.
No, so to your point then of a sort of hardish, landing, tougher recession, even if it's shallow. How does sort of this almost full employment that we have, how does that relate to it? I mean, how is that going to work? How are you going to have, can you have a full employment recession, or a recession where there's so many jobs available? And what kind of pressure does that, or is there an inverse pressure?
Again, we've had this before in 73 and 75. For 8 months into that recession, employment continued to go up. And so, but one of the things you got to take into effect, and this is something that, a lot of people don't, is the inflation, is that inflation is still higher than wage growth. And what happens is that people feel like they're moving backwards, even if they have a job, and even if they're spending, they're spending more on their credit card interests. They're spending more on mortgages, all of these things. And what's happening is they're slowing their spending, and we saw that dramatically in some of the recent reports, especially for December, is that you can have a slowing economy even though people are actually working. And it's the slowing economy that causes a recession.
Yeah. And then, so these, 10.5 million jobs that are sort of out there, if you have one and you still have to pay all this extra money for eggs now or whatever it is, you're still going to feel it. And that should have a downward pressure, as well. So, Art, as this, recession, as you see it, that comes up, how long would something like that last if it's sort of shallow? And we're all sort of in agreement maybe that this is coming, or we're in it maybe already. Would that 10.5 million jobs kind of stay there and be sort of, that's the exit? We come out of it with it, or does that apply a different kind of pressure in your mind?
No, and I think that the Fed has brought this up in the last 3 meetings. That number, or that ratio of jobs available as a percentage of people looking for jobs, needs to come down. It got as high as 2 jobs for every person looking for one. And we're now down to 1.75 jobs for everybody looking for one. Before the pandemic, we were at 1.2. So, and that's kind of the normal level. So I think what you're going to see is JOLTS comes down first, weekly jobless claims comes up next. And then you'll see what's important, the non-farm payroll numbers, or the monthly jobless numbers, start to come down. And then we start seeing 125,000 to 150,000 jobs created every month, as opposed to the beginning of last year, where it was 450. And the end of last year, the final quarter, we averaged 250. So we're heading in the right direction. It's just painfully slow because the labor market is so robust.
Do you guys spend any time thinking about what sort of I mean, everyone beats these poor millennials up day and night, but do you spend any time thinking about what is supposed to be new work, right? I'm working from home. I'm not going to be, and then what effect that has on the cities and the economies of those cities to, I'm only working 4 days a week. I'm not going to work the 5th day. I mean, obviously when you start changing the labor dynamic, that goes more in favor of employers now, but do you see that having a long-term negative effect, or people, there's also that idea of quiet quitting and people, I'm not interested in advancing. You know what I mean? That seems to be is that just a poof, or you think that there's some reality to that?
Well, I would tell you this, if you look at the millennial generation, the peak of that generation, the peak of household formation is happening right now. And it's this year, and the age is 33. So that's when you sort of start household formation. That's the peak of this huge bolus of population right now that's called the millennials. And they get, a lot of poo-poo, as you mentioned, for, sort of quiet quitting, or, actually wanting to work from home, and all sorts of things that have happened over the last couple of years. But here's what happens in reality. Household formation means you move out of your parents' basement, get a girlfriend who becomes your wife, you start to have kids, you buy a home, and you become a very important part of the U.S. economy. All of that, all those things that you did before then sort of wash away pretty quickly. We've seen that in every generation, whether it was, Gen X, we're going to see it with millennials, we're going to see it with Gen Z. And I think, it's just that household formation starting, and that's really starting in earnest. I think that's one of the things that's really underpinning a lot of the housing market right now.
But, Paul, with the tech companies and things like that, we saw an acquiescence to this. Oh, yeah, sure, you can work from home. Oh, yeah, we'll do this. There was a lot of, I can't imagine my boss, I was there telling you go to work from home, that would have been, he couldn't smack me. I don't think that's against the law, but there would have been like it depends.
It depends. We found at B. Riley that we were more productive while people were working at homes. People, they started working when they used to get on their train to, go an hour into Manhattan. And so we found that the productivity was up. Now, there are only certain industries that can measure that kind of productivity. You can't do that in government. You can't do that in certain other places, but certainly in certain aspects of the financial services and in all aspects of tech. You can code from anywhere, and you can actually see whether these people are productive or not. And that's going to be the key. Companies that can't show productivity, they're going to bring people back in to workplaces.
Ultimately, I just feel like it's unfair. I have kids that are 27, 20, you may also are, but 25, 24 going into the workforce. And it's just very difficult to not have mentors, or not to be in an office, not to be able to go to a business lunch and see what that's all about, not to have somebody to talk to ask questions. It's just harder for them. I know they feel like they like to work from home, but I think it's harder. All right. Housing boom, housing bust, housing everything aren't, it's obviously a big, people's portfolios is important, right? Having a job is important. We sort of touched on those, but then comes of course their health, but their housing, so that's a big part of what people worry about. What are you seeing out there?
Yeah, what's amazing is if you look at the new data, the data we've seen since July in terms of housing, so prices have come down pretty significantly. That won't show up in the CPI and PPI for several months. But in real life, what we're starting to see is an interesting dynamic. And I think we can all agree that obviously, if you're able to get a mortgage at or about 2.5%, 3% for the last 10 years, you feel great about it. But that's not normal, right? And then mortgages got all the way back up to close to 7% in some areas. And now it's started to tick down. And if you look at the weekly mortgage apps for the last 3 weeks, we've seen an increase of 25%. I think demand is on a relative basis is starting to pick up significantly. And I just talked about that millennial generation, that first-time home buyer that has pent-up demand, and we're undersupplied. So I don't think what we're going to go through is a housing crash. As a matter of fact, I would make an argument that the recovery is already starting in that sector. That was the first sector to go into its recession. And I think it's going to be the first sector to come out of its recession for some pretty obvious reasons. But we've underbuilt single-family homes in this country since the great financial crisis. And again, more demand than there is supply. The actual pricing is going to get to the right level. But I certainly think the housing industry in and of itself is in pretty good shape. If you look at the home builder sentiment that just came out last week, first time we've seen it be positive in a year. And if you look at the home building stocks, they've actually had a significant move over the last 2 months, up 25%.
Paul, what do you think about housing right now?
I agree with Art. One of the things I always find interesting is that with already existing homes, not new homes,
Yeah.
but already existing homes, that the prices really haven't come down all that much. And the thing is, you can see that there's no sales, but the owner actually puts the price in, and they're just saying, well, I've got a mortgage at 3%, and
Right.
if I don't sell, I'll sell in a year, when we're out of this recession. And so I don't see that as, and I agree with Art that will be one of the first industries that comes back after.
So in terms of a recession, I mean, I guess we're keeping our jobs, and our houses may end up being worth more, or at least if you were lucky enough to do a mortgage, a couple of years ago, you're feeling that's an asset that's got a good return for you right now. So do both of those things help counter consumer inflation and the fact that, does it make it a softer landing?
Well, I can tell you this, the way I would look at that is, how you define recession and who it affects the most. And I think there's a possibility that we have much more of a corporate recession than we do a consumer recession. And to the points that you make, so the stability in your house price and the fact that you've got a job or you can get a job if you need one are the backbones of consumer confidence, right? But the flip side of that is overall demand, especially from the enterprise in terms of spending. We saw that with all the software companies, including Microsoft and certainly Intel last week. But the corporate spend, the enterprise spend may well have already entered a significant slowdown that you would actually, call a recession. So you actually may have a consumer that's about 2/3 of the GDP actually weather the storm a whole lot better than corporate America does. And I think that's okay. And I think that's the way I look at this. That's the way I would define the soft landing, where the consumer actually ends up being okay, but earnings come down on a year-over-year basis.
So Paul, earnings coming down, that can't be good for stocks, right? And then Art didn't really factor inflation into that so much. So what are you still pro hard landing? Given everything we discussed.
I don't believe in a hard landing. I think this is going to be a recession, but it's going to be a shallow recession. I think when most people talk about soft landings, although I haven't always gotten a perfect definition of that from people who talk about it, but I think they're thinking that there's going to be no negative GDP growth for 2 quarters, and I don't believe that's going to happen at all. And also, if you start looking at the leading economic indicators of new orders, and we saw them just drop off precipitously in December. New orders for manufacturing were really down. New orders for consumer, and this is where I disagree with Art on the consumer, was really down. Inventories are up. That basically made the GDP look a lot better, but that's not good because they didn't sell that inventory in the last quarter. And so what you have is a slowing, and because of inflation being higher than the wage growth, and I think it will, you'll continue to feel that inflation. Even if it stays the same as it is right now, you'll continue to feel it, and people will feel like they're going backwards, and that will make them not spend.
So the only other thing, I know, Paul, you talk about the international stuff a lot. It also seems like, I've always thought, Art, that China was kind of, a fugazi, right? It's just who knows what their metrics are, the graph, the corruption, all that stuff. But there's now that it's sort of consolidated into a one-party state, right? There's only one school of thought that you can have, and it's top down on the chips. I mean, there was another article in the journal today about how soul crushing. There's no innovation in China because of the way they sort of build their stuff. So I'll ask both of you, but, Art, you first about China, and, that's sort of the competitor of ours, right? That's also a wild card in terms of a political thing that could sort of screw up the whole, any kind of landing, right? So where do you see that? And this will be our last question. So we'll let you.
Sure. I'll tell you the positive on the one hand and the negative on the other. Positive, very important. China for 3 years had a zero COVID policy they just got rid of. So China is actually reopening in earnest. They just went through their 2-week national holiday, and obviously COVID's cases have spiked, but their demand for goods and services in the global economy is going to be back in earnest in the first quarter of this year. That has been missing or spotty. Their manufacturing of the goods that we need is going to be back in earnest. That recovery has been very spotty. So a reopened China, truly a positive for global demand for goods and services. And I think that's the positive. The negative is demographics in China are abysmal, and their actual population will be smaller than India's by the end of the decade. They're fighting a losing battle that way. So
that was that whole one child policy and all that. Now,
right.
now they're old, right? So you get
right. And that's going to be very difficult for them to orchestrate that kind of 6% GDP growth rate that they have in all of their targets. But I think in the very short term, for the next 2 years, the fact that China is going to be opened in earnest, it's been a very spotty rollout of reopening China for the last 3 years, is a net positive for the global economy.
So, Paul, all that being said, hard to disagree with those points, but at the same time, it's can you trust what they say about where they are or where some of the industries are? I mean, they had this real estate thing. Who knows what really happened with that? You know,
that's a real concern, is the real estate in China, and the possibility of that. What they do over there is that they sell the condo before they build the building, and so most of the people, it's the average person who's going to lose the money, because they're just not building these things that they've sold, and they're going bankrupt. It's a real problem for the consumers over there, and I don't there have been studies about this. Nobody knows how they're going to fix this, but it's the one big risk factor out there. The second thing is that as they have to buy commodities again, and we are seeing commodities prices going up, that's going to lead to a certain amount of global inflation that we're going to get, because copper prices are the same here as they are in the rest of the world. Same way with oil. Oil is already starting to go up, and what happens with commodity prices going up and oil prices going up, and I don't know when that filters into our inflation, but I'm thinking in the next 2 months we may see some upticks in inflation, not what we've seen over the last 6 months of inflation going down. So I agree with everything that Art said, but I do think this is going to cause more inflation. I don't really see how it's going to help the US if we're slowing our spending as consumers and manufacturing seems to be doing. It's going to help China, but I don't know that anything other than seeing more inflation here in the United States and higher commodity prices, that it may have a negative effect here in the US and in Europe.
Art, you look like you want to say one more thing, Art, before.
Yeah, it's every silver lining has a cloud, I guess, in some places. So it's when I look at it, is we were concerned about China not having their demand for our goods and services globally for the last 3 years. All of a sudden we're getting it, and the first thing we're going to be concerned about is that might be mildly inflationary. Our supply chains are just now getting back online, and I think all the things that we need from China and our symbiotic relationship are going to be back. I think the net is a positive, at least for the first couple of years. I don't disagree with Paul in terms of pricing. I think this puts a floor in what otherwise was a deteriorating commodities market. We saw a significant fall off in energy prices and the industrial metals. I think this puts a floor in. I don't know if we're going to have a re-escalation if it's just China getting back in the commodities market.
Great. All right, gentlemen, this has been a great call. I'm looking forward to doing it again. And I know that, speaking for the advisors, they appreciate your candor and your help on sort of sorting out some of these things. So thanks for being here. I really appreciate it.
Thank you.